Do you want to understand one of the keys to get more lending and potentially grow your portfolio substantially? I'm going to give you a hint. It's not in the big, fun, shiny parts like people like to talk about. As an accountant, I can tell you how many millions of dollars are lost by people not paying attention to the details. So in this episode, it is exactly those details that I'm going to unpack. In terms of preparing for a loan and understanding what so many people do wrong, as well as talking about the right ways to do it and how much of a difference extra lending now, when done correctly, can make on the growth of your portfolio over the long term. I'm Iannuzzelli. This is what school should have taught you. Let's get into today's episode.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
So the first question that I want to make sure that we address is, what do people actually get wrong? Now, the biggest thing that I talk about with many of my clients, yes, we talk about goals and objectives, but we also want to strategize, where is their window of opportunity? Has their business or have their tax affairs or has their income been at its most strongest point? Now, that's an important thing that you want to make sure that you're looking at and discussing, because if you've had a cracker year, whether it's at your work and you've received some really good bonuses, commissions, had a big bulky pay rise, and you might be looking to maybe go start your own business, or you've had a business and it's had a fantastic year, that is that window of opportunity that I'm talking about. That is that time where you want to use the numbers, use the position that you're in to go and obtain more lending. So borrowing money, buying property is not this beautiful arrow that just continues to go up year by year. It comes in waves. And when that wave is there, you want to make sure you ride it all the way to the end. Then you get to the beach and then you paddle back out, do the hard yakka and find that next wave. And it might be 2 or 3 years in between. So what I'm talking to my clients is, guys, have you had a crack a year? Is this probably one of the best years that you'll have as you can foresee? If the answer is yes, then we really try to improve the numbers as much as we can. We try not to spend money on expenses prior to the end of the financial year. We try not to do big bulky items. We try not to get additional lending like car loans or personal loans or have huge amounts of credit card debts. We really try to consolidate our spending as much as we can. And that means personal items. So we don't want to be spending huge amounts on holidays and takeout foods and entertainment or gambling or drinking, because these are the things that really limit HEMS, which is your living costs. These are things that may limit your business profit, which is what translates into additional borrowing capacity in the future. So being an employee or being a small business owner, the things that you need to have a think about is, have I had a cracker year as far as my income is concerned? If I have, or I am having a cracker year, try to limit the amount of spending that you do. Now, yes, it does mean sometimes more tax needs to be paid, but real business entrepreneurs, real business people that have got a lot of wealth are comfortable with paying tax. Now, it's not all about paying tax on income you haven't earned, because that's stupid, but it's about paying tax on the income that you have earned, because I've said it in various podcasts. More tax equals more profit. More profit equals the ability to obtain more borrowing. More borrowing gives you the ability to build more wealth. You can't have a low income. You can't shove thousands upon thousands of dollars worth of expenses into your business to bring your profit low, to pay very little tax, and then go to the bank and expect that you want more money. You may be able to do that under low doc or no doc loan terms, but you're going to be charged a very hefty penny for it. Interest rates of 7, 8, 9, or even 10% plus. So the sophisticated investors out there know when they're having a really good year and will actually prime themselves for borrowing, which means reducing their costs, reducing their living costs, improving the profits of their business if they're a small business owner. Yes, it translates to more tax, as I said, but it's going to give them the opportunity to borrow more money. Now, you're probably thinking, well, Jeremy, why am I going to be paying all this extra tax? Yes, I want to get more loans and buy more property, but why am I doing this for? What's it all for? Well, any investor will tell you that you want that level of compounded return. Now, the most successful people out there have not done it with cash. They leverage their way into assets. Now, leverage is not for everybody, and I'm not going out there to say that you should hock yourself up with all debt. Make sure you chat with your mortgage broker or your financial planner so you've got a very solid strategy of why and when you're doing this. But for me and a lot of other investors that I manage, they're very comfortable with debt. Now, comfortable with debt means they've got buffers in place, and you've heard me speak with numerous professionals talking about ring fencing a certain amount of cash for the ability to pay for future costs or future renovations of the property portfolio. But if you can show some really strong numbers from a borrowing perspective and get yourself into a market when it's maybe slightly starting to move upwards before the pandemonium kicks in, which is thousands of people turning up to properties on a weekly basis, that is when you're starting to have multiple assets and you hear me talk about a larger denominator. For me, I want to try to have have the largest denominator that I possibly can in the market. Why? Because very small percentage movements on a very large denominator result in large gross gains. I'd rather have 2% on 20 million than 5% on 1 million, because the larger denominator, the smaller gross percentage returns translates into larger amount of gross capital value that's been increased in my portfolio. But I still need to make sure that I can manage my cash flow and have those properties being well looked after by their rents and even giving me money in return. So for me, I want to make sure that when I've got a really good year, I can strategize correctly, pay the right level of tax, and then leverage into properties. Now, when I know that I'm going to set myself up for a year of costs, which means maybe investing back in my business, or I want to take the family away on some really good holidays, or I know there's going to be some money that needs to be spent around my own principal place of residence, that is a year I'll pull back. That is a year that I'll focus on tax minimization, because I've got no inclination of wanting to buy any more property. You've seen me go through a recent episode over the last 12 months of my most recent 4 purchases, and that was set up over 12 to 24 months ago. I knew 12 to 24 months ago I wanted to go quite hard in the property market as the interest rates started to go up. Because remember, our old dear friend Warren Buffett says, get greedy when others are fearful and fearful when others are greedy. I saw interest rates going up as an opportunity for me to go into markets where other people necessarily aren't looking, such as potentially like commercial properties or office space. Interest rates are high, people can't afford to pay the interest, prices do come down. Development properties, no one's got the capital to be able to fund the interest during that period of time before you build. I did at that particular stage because of all the good things that I did 12 to 24 months before transacting on those properties. So for anybody that's listening, thinking about, well, I just need to continue to do the same thing, I always like to have the notion of what got me here won't take me there. And that means it comes from a strategy perspective. I'm looking 12 to 24 months in advance and making decisions now to maybe transact at that time. But when there is a period of time where I'm not looking to leverage into the market, I want to maybe take a break, consolidate, build up my buffers, that is when I'll start to focus on my tax minimization, investing back in my business, again, minimizing the amount of tax that I pay, having those expenses that I've been putting off for some time, doing that renovation at home, taking the family away. So you really need to make sure you're looking 12 to 24 months in advance in summary, making sure that you've got the leverage or the ability to leverage into the market at the right time based upon your strategy. Speak to your broker, speak to your accountant, speak to your financial advisor. If you can have all those things clicking at one time, that's when you're going to have a sustainable portfolio and the largest denominator that you possibly can have in the market at any one point of time. If you're liking what you're hearing and you're listening to us on iTunes and Spotify, don't forget we've got our YouTube channel, What School Should Have Taught You. Hit the like and subscribe so you can always get notifications of our next episode. I'm Iannuzzelli, and that is What School Should Have Taught You.